Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Wednesday, June 17th, 2026. We're Elena and Marcus.
And it has been a deeply aggressive session today.
Yeah, imagine waking up to find your safest, most reliable portfolio allocations suddenly, acting like highly volatile meme stocks.
Yeah.
Because if you were looking at your screens right now and seeing both your long-term tech holdings and your gold positions bleeding out simultaneously, well, you are witnessing exactly what happens when central bank reality violently collides with market complacency.
It's a real shock to the system for a lot of institutional players.
Right. So looking at today's data deck, we really have four critical themes we're tracking for you. First, we are dissecting a severe hawkish repricing in global interest rates, and this comes directly following Kevin Warsh's highly anticipated debut as FOMC chairman.
Yeah, that's the big one. And second, we will break down a brutal sector rotation. Institutional investors essentially treated long-duration mega-cap tech and European autos like liquidity ATMs today.
Well, financials actually caught a very distinct structural bid. Then third, we are looking at the energy complex, where long-term bearish supply forecasts are colliding directly with critically tight physical oil inventories.
The tension there is just extreme right now.
And finally, we will synthesize what this synchronized cross-asset move signals for your portfolio for the remainder of coming 26.
We definitely have a significant amount of complex ground to cover because the entire front end of the yield curve was completely upended today.
So let us start by unpacking that core catalyst. Because looking at today's proprietary updates, the headline number itself was not really the shock, right?
No, not at all. The FOMC held the Fed funds target range steady at 3.50% to 3.75%.
And that decision was unanimous.
Right, unanimous. The real earthquake, the thing that entirely shattered the market's pricing models today, that came from the revised dot plot.
Yeah, because the median rate projected for the end of 2026 leaped roughly 37.5 basis points, putting it at 3.75%.
Exactly. So half the committee is now explicitly penciling in at least one rate hike this year.
Which caught almost everyone off guard. And to compound that, Chairman Warsh announced a dedicated task force to review the central bank's $6.7 trillion balance sheet.
Which implicitly signals a severe risk that quantitative tightening is about to accelerate. That task force announcement is a massive structural signal to the markets.
So what was the immediate reaction on the desks?
Well, a violent repricing in the front end of the curve. The two-year Treasury yield surged to 4.161%. That is a massive jump of 13.1 basis points.
13.1 basis points in a single session.
Yeah, it's huge.
Yeah.
And meanwhile, the 10-year yield rose 4.9 basis points to 4.463%.
Indeed. And that effectively means the July 29th FOMC meeting is now entirely live, right?
Yeah, dealer desks are currently pricing in a 30% to 35% probability of a hike at that July meeting.
Understood. But let's apply our first principles here. The data shows a classic bear flattening of the yield curve today. For the non-professional investor listening to this, what does a bear flattening actually mean for their portfolio mechanically?
Right. So it is a crucial concept to grasp. A bear flattening occurs when short-term borrowing costs, represented by the two-year yield spike, significantly faster than long-term economic growth expectations.
Which, just to clarify, are represented by the 10-year yield.
Correct. Think of it like a corporate chief financial officer who suddenly faces a massive, sharp increase in the interest rate on their immediate revolving credit line.
While their 10-year revenue projections remain completely flat.
Exactly. It signals the market believes the Federal Reserve is actively slamming the brakes on the economy right now to fight inflation.
And when short-term risk-free rates jump that aggressively, it directly threatens the valuation of long-duration assets, right?
Yes, because the future cash flows of those growth assets are suddenly being discounted at a much higher penalty rate.
Wait, let me stop you there. Because if we look at the global context from our daily desk data, earlier today, the Bank of Japan actually hiked rates to 1.00%.
Yeah, which is the highest level we have seen in Japan since 1995.
Right. So logic dictates that a historic Japanese rate hike should strengthen the yen. Why did the U.S. dollar index surge 0.86% instead?
Because the shadow of the U.S. Federal Reserve is simply overwhelming the Bank of Japan right now. The Fed's hawkish shock was so severe that it created a massive gravitational pull for global capital.
Because capital just naturally flows toward the highest risk-free yield.
Yeah, so despite the Bank of Japan's historic move, the U.S. dollar surged anyway. pushing the USD-JPY exchange rate up to 160.65.
And that specific level places dealer desks on high alert for official currency intervention, doesn't it?
Oh, definitely. Uncoordinated currency intervention from the Japanese Ministry of Finance is a huge, huge risk right now at that 160.65 level.
Moving to today's data, we really need to see how those exact rising discount rates mechanically routed specific equity sectors.
Yeah.
Because the S&P 500 dropped 1.22% today, closing at 7,420.
Yeah, and that sell-off was heavily concentrated in the final 2 hours post-Fed. The de-risking in technology, media, and telecom was just severe.
Long-duration equities were actively used as a source of funds.
Right. The Mag 7 basket fell 2.5%, and broad software was punished, closing down 2.9%.
We should name the specific vehicles being utilized here. Apple, Meta, and Amazon are highly liquid names.
Yeah, and when institutional portfolios take a sudden hit on a rate shock like we saw today, they need to reduce leverage or meet margin requirements immediately.
They do not try to sell their illiquid, hard-to-move assets.
No, they go directly to their most liquid holdings. They essentially treat Apple, Meta, and Amazon like an ATM to fund their sudden cash needs.
That is a highly accurate way to frame the flow data. However, there is a critical nuance within the technology sector that our latest run highlights.
Right. The aggressive selling was heavily concentrated in software and consumer tech, but AI hardware actually remains bulletproof.
Yeah, memory and DRAM equities are maintaining a parabolic trajectory. I mean, earlier in the Asian trading session, Tokyo Electron closed up 2.5%.
Which means the market is actively distinguishing between software companies, which are highly sensitive to discount rates, and the companies building the physical, capital-intensive infrastructure of the AI cycle.
And if you want to see how these exact rising discount rates choke off the real economy, you just have to look at sectors that rely heavily on consumer financing. That is why industrials and autos were under immense pressure today.
We saw a brutal bellwether warning out of Europe on that front.
Yeah, BMW dropped 8.3% after slashing its profit forecasts.
And the primary catalyst they cited was rapidly deteriorating Chinese demand.
And that single warning dragged down the broader auto and chip supplier subsectors across the board, specifically pulling down Infineon.
It really highlights the extreme vulnerability of cyclical, export-heavy sectors when global growth expectations are being aggressively dialed back. But let us look at the flip side of the bear flattening trade. Financials were the sole structural beneficiary of the day's flows.
Right, because banking business models react mechanistically differently to the short end of the yield curve.
Precisely. European banks saw a massive bid. Specifically, Commerzbank rallied 5.2%, closing at 2008 highs pre-Fed.
Furthermore, U.S. banks demonstrated significant relative resilience during the afternoon sell-off.
And the fundamental reason is that a steeper short end of the yield curve mechanically boosts expected net interest margins.
Because when short-term rates rise, banks can rapidly increase the yield on their newly issued loans and floating rate assets.
Yeah, meanwhile, they typically lag on raising the interest rates they pay out to you, the depositor. That spread expansion equals pure profit for them.
And as this sector rotation was unfolding, volatility woke up aggressively. The VIX spiked 12.4% to 18.36.
Yeah, and looking at our latest run of the dealer positioning data, this was not just fundamental fear from human traders. This was a mechanical short gamma liquidation event.
The mechanics of short gamma are essential to understand if you want to know why the market falls so rapidly. Think of options dealers like massive sports bookies.
Right. When the market is quiet, these dealers are positioned in a way that requires them to buy when the market dips and sell when it rises, which suppresses volatility.
But today, when the Fed shock pushed the indices down through key technical support levels, that positioning completely flipped.
Yeah, they were forced to sell delta.
Meaning they had to aggressively short the underlying indices just to hedge their own books.
Yes. Returning to the bookie analogy, imagine a bookie suddenly receiving a massive influx of bets on the underdog, forcing them to frantically place opposing bets just to balance their ledger.
So they're just chasing the market down.
Exactly. That mechanical selling by the dealers accelerates the downward momentum, turning a normal dip into a sharp, self-fulfilling cascade of market movement.
On that point, regarding global growth fears, like we saw with BMW's warning in China, let's transition to the direct impact on commodities and hard assets. The energy complex is currently flashing some deeply conflicting signals.
Yeah. WTI crude fell 0.56% to $75.88, and Brent dropped 0.94% to $78.76.
Because if you look at today's proprietary updates, the International Energy Agency slashed its 2026 demand forecast.
Furthermore, they warned of a massive 2027 supply glut, predicting that Gulf production will fully normalize following the U.S.-Iran peace deal.
Right, the paper markets are heavily trading this narrative of future excess supply. But I have to push back on the IEA's bearishness here, or at least offer the countersignal we are seeing right now.
Which is the physical market.
Yes. Paper traders are selling based on a 2027 glut narrative. But our daily desk data shows that physical Cushing inventories are sitting at operational tank bottoms of roughly 20 million barrels.
To put that in perspective, that is critically low. That is less than 2 days of total U.S. production.
You cannot drain those physical storage facilities to absolute zero without damaging the infrastructure. It is like driving a massive freight truck on the highway while the fuel gauge is resting entirely below the empty line.
You can technically keep moving on the fumes at the bottom of the tank, but one wrong bump and the engine stalls.
Exactly. Furthermore, tankers are actively moving through the naval blockade right now.
Which implies the physical market has already priced in the formalization of the Iran deal.
Precisely. The deflationary relief of the peace deal is fully baked into the current price of Brent and WTI. But with physical inventories at the bare minimum, there is functionally zero buffer left in the system.
Right. So if there is even a minor snag in the geopolitical negotiations or an asymmetrical supply shock anywhere in the world,
the physical market is uniquely vulnerable to an upside explosion in price because there is simply no stored oil to smooth out the disruption.
It is a classic tension between long-term paper forecasts and immediate physical reality. But the carnage was not limited to energy. Precious metals suffered heavily today as well.
Yeah, gold fell 1.72% to $4,256 per ounce.
And silver dropped 3.00%.
Which perfectly aligns with the macroeconomic forces we just mapped out regarding the Federal Reserve.
Right. The mechanics are straightforward but punitive. The hawkish Fed shock created a massive spike in real yields.
Real yields being the risk-free return you get on a treasury bond above and beyond inflation expectations.
Yeah. Because the Fed shock spiked real yields and the U.S. dollar surged simultaneously, it effectively crushed non-yielding hard assets.
Because gold pays no dividend and no coupon.
Exactly. If you can get a guaranteed return of over 4% on a 2-year treasury, the opportunity cost of holding a block of gold suddenly becomes exceedingly high for an institutional manager. They are forced to rotate out of the metal and into the yield.
So if we look at the individual moving parts across the board today, we have a very clear picture. Equities are down, 2-year rates are surging, the dollar is spiking, and gold and oil are falling.
Correct. This is the textbook footprint of a hawkish Fed shock.
Every single asset class moved in perfect, synchronized alignment with the realization that global dollar liquidity is tightening.
Yeah, there is no place to hide.
What does this synchronized cross-asset move suggest about the broader economic regime we are entering for the second half of 2026?
It tells us the market is officially transitioning away from the higher-for-longer complacency we saw earlier this year. We are moving into a stagflationary adjacent environment.
Because the Federal Reserve, under Chairman Warsh, has explicitly prioritized price stability over the labor mandate.
Right. They are communicating a willingness to tolerate severe economic pain to ensure inflation does not become entrenched.
The market's primary message today is that the Fed put, the long-held idea that the central bank will step in to rescue falling asset prices is entirely off the table.
The institutional consensus is that the next move is genuinely a rate hike, not a rate cut.
Which brings us to our look-ahead catalyst. Tomorrow morning, we get the U.S. jobless claims print.
Which is critical.
Yeah. Why should you, the listener, care about a weekly labor metric in the middle of this massive global rate repricing? It matters because any softening in the labor market data instantly complicates this newly established July rate hike consensus.
If jobless claims spike, it challenges the Fed's ability to completely ignore the labor side of their dual mandate.
A weak labor print could violently reverse the massive short-end curve move we saw today. You have to monitor the data that directly challenges the prevailing narrative.
And as you monitor those domestic labor markets, I want to leave you with a broader global dynamic to consider regarding the U.S. GGPY exchange rate sitting at 160.65.
Right, the intervention watch.
Yeah. Challenge yourself to think about what happens to global dollar liquidity if Japan is forced into a massive, uncoordinated foreign exchange intervention to prop up the yen.
What happens if they are dumping U.S. treasuries to fund that intervention at the exact same moment the U.S. Federal Reserve is threatening to hike rates and shrink its balance sheet?
Exactly. When the two largest central banks in the developed world are operating at crowd purposes, volatility rarely stays confined to currency markets. It will inevitably bleed into every asset class we discussed today.
That is the exact tension we will be tracking as the week closes out. To recap today's massive shifts in just 30 seconds, Chairman Warsh shattered interest rate complacency, sending two-year yields soaring past 4%.
Highly liquid tech names and auto stocks like BMW were used as funding sources to meet immediate institutional liquidity needs.
And the energy complex is locked in a fierce tug-of-war between long-term IEA glut warnings and critically tight physical storage at Cushing that leaves the market highly exposed to a supply shock. Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color.